Hello and welcome to Switzer Investing. I'm Peter Switzer, and on today's show, Junbei Liu of Tribeca Alpha Plus looks at the stocks she doesn't like for a change. Paul Rickard reveals 4 great income stocks that are really worthwhile thinking about. We explain why a small cap stock called Space Talk has seen its share price rocket higher since Friday, with the company's CEO Mark Fortunato, and Julia Lee of Berman Invest looks at what she's buying and selling right now. So without any further ado, let's go to Julia Lee and she can tell us what are her current market plays. Welcome to the show, Julia.
Great to be here, Pete.
You know, the history has been, I've often got you to tell us what stocks you like, but tonight I'm going to get you to tell us what stocks you don't like at the moment. Stocks that, that were once in your bag of collector stocks that now you just don't think the timing's right for them, or there's something wrong with the company.
Yeah, I mean, there's a lot of companies that we've rotated out of, and a lot of them are retailers that I still like, but we've seen the share price falling quite substantially. So we're out of stocks like JB Hi-Fi, Domino's, Metcash, as well as Wesfarmers. So we really have moved away from some of those COVID winners into the COVID losers. We're now in stocks like Qantas, corporate travel, to get access to that reopening theme. And like most things in life, I think the share market moves in cycles, and the part of the cycle that we're at the moment is all about economic growth and recovery. So we're leveraged to things like the banks, which do well because they're a leveraged play on what's happening in the economy, and the economy is doing well and is forecast to do even better, as well as things that are exposed to the reopening of the borders and coming out of COVID-19.
And for the Switzer report today, I think you surprised Paul Rickard when you liked Virgin Money.
Yeah, I mean, Virgin Money is one that's been on the radar for a little while now, but looking at the UK, and it's quite interesting what's happening over there. I mean, they've had such severe lockdowns, and my sister's over there at the moment, pregnant with her second child due in a couple of months, and they're, of course, rolling out vaccines. She can't take it because she's pregnant, but her husband's already had his first injection. And as they look at the reopening and coming out of lockdowns, it of course is about recovery and economic growth. And of course, Virgin is the old Clydesdale, as well as the Virgin Money acquisition over in the UK. And as economic activity happens once again, not only is loan growth going to be good for Virgin Money, but also the winding back of those provisions that happened in COVID-19 are going to be a key driver of earnings growth. And then adding to the mix, property prices around the globe are going nuts because of those low interest rates, and it's a nice combination for Virgin Money.
Okay, really interesting one. Let's go to 3 stocks that were mentioned in our Boom Doom Zoom webinar the other day for Switzer Report subscribers. And these aren't companies that I know all that well. Star Pharma, what do you think of Star Pharma?
Yeah, I mean, Star Pharma, traditionally the revenues have come from Vivagel, whether it's Vivagel coated condoms, which kills sperm, or Vivagel BV, which is for bacterial vaginas. But more recently, I guess it's been making news because of possible COVID-19 applications, and in particular looking at, I guess, an injection of one of the treatments for COVID-19 rather than through IV, because they've been able to find a water-soluble version. So that's been quite exciting for Star Pharma, and then of course the nasal spray as well. Of course, as vaccines are rolled out, the addressable market for COVID-19 continually shrinks, so it's back to more of those traditional plays. But having a look at Star Pharma, it doesn't look too bad here. It is speculative, and look, they aren't profitable as yet. So if I was putting some money in, I'd just be putting a little bit in. The reason I'm cautious is because in the last 6 months, this really has been a COVID-19 story. And of course, as vaccines are rolled out, it is forecast that less people will be getting COVID-19 and hospitalized. So the addressable market for those COVID-19 products, of course, is shrinking while they're going through the phase 2 trials for those COVID-19 products. So I guess just a little bit of cautiousness here for Star.
And I guess the interesting about Star Pharma, considering where its traditional market comes from, the more we reopen and the more we start getting back to entertainment precincts, when they start building up and people are going out, when you think about what they sell, wouldn't have been.
I'm wondering where you're going here,
but
Pete.
wouldn't have been helped by the fact that pubs and clubs are all closed down. Like, you're the one who was talking about this, and I started thinking laterally. Obviously, there's a lot less of the kind of stuff that helps that company going on. Okay, that'll do. We're going to go further. Let's go to the next one.
Moving on from a tangent, one of the things that I've constantly been debating in my mind was whether there would be more babies born because of lockdown and COVID-19 or less. But it's looking increasingly like there's being less babies born, not only here in Australia, but China, as well as Europe. So I'm really cautious on anything baby related. In fact, I'd be completely out of anything baby
And given what
related.
you said, Star Pharma's not creating babies, it's sort of stopping babies.
They're trying to prevent
That's
babies.
right. Let's go to Novonix now.
Yeah, Novonix is an interesting one because we know that battery materials have been the flavour of the year, and Novonix is no different. The share price is up very strongly over the last 52 weeks, even though over the last couple of months we've seen a pullback. And what Novonix looks at is graphite. And when you look at the graphite market, I guess you can separate it into things like the size of the flake or the graphite flake, together with the carbon content. And generally, the larger the flake, the more valuable it is and the more applications there is. And usually when you're looking at it for lithium batteries, you want to see graphite flakes, which is higher quality. But I think the difference with Novonix is that it has the technology to convert, this is all about synthetic graphite production, because not only can you mine graphite, which is used in batteries, you can also turn the lower quality graphite into the higher quality through technology. The only downside to that is that it has been quite expensive, at times 10 times the cost of just mining it. But I guess that's one of the attractiveness. That's one of the attractive points for Novonix, that it does have access to the synthetic graphite technology. Look, this is one that's unproven, so it's still quite early stage. It does look quite interesting, so I would rate it as a speculative buy if you wanted to put a little bit of money in. But I'd also put a bit of money in some of the other more established players in terms of the graphite market, and that is Sierra as well as Talga Resources. So Sierra is over in Mozambique and Talga is in Sweden with its deposits. So maybe spreading some of that money and love around in terms of some of those battery materials in the area.
Good observation. Finally, bet makers, BET.
Yeah, bet makers, instead of being a technology play where people can go and place wagering bets, they're actually the technology behind it and the platform. So companies can either white label their platform or they provide the analytics and the back part of things. The big thing for bet makers is really the US market, which is much larger than the Australian market. And over in the US, there are some counties where it's still illegal to do fixed priced odds. And they're trying to sort of change that, especially in New Jersey, which I think is the next place where they're trying to get fixed odds okayed. And of course, that's a massive market for bet makers. This, once again, is speculative, but I like this because we have seen quite a lot of corporate area in this space, whether it's with Tabcorp, whether even it's with News Corp's betting arm. I think it's called Newsbet over at Foxbet, maybe over in the US, which is also to move into Australia. So look, this is an area with a lot of corporate activity, so potential takeover activity down the track here. So bet makers, once again, speculative, but I think this one looks the most interesting out of the three at this point.
Just before we go, Julia, you're the one who brought up Foxbet, and there was a story around last week that possibly Lachlan Murdoch, and I presume through the Foxbet, we're looking at Tabcorp as a possible takeover. Have you had any thoughts about Tabcorp since there's been a few changes there?
Yeah, I mean, Tabcorp's Corp's assets are in focus at the moment because there are a number of parties circling. So it's quite interesting seeing what's happening on the Australian market at the moment because, of course, Crown also received a potential takeover offer today as well. So that wagering side of things and the betting side of things, definitely there are things on the move at the moment, and quite a few international parties are looking into some of the Australian assets, which I think is quite interesting. And for investors, this is not only interesting from a potential takeover point of view, but a valuation point of view. Usually when you see a takeover of an asset, it's around about a 30% premium to get that control over the company. And of course, that has implications for other peers in that asset class. So as an analyst, you usually see those takeovers, and that gives you an excuse to revalue some of the peers in that space as well. So that corporate activity is generally a positive for the whole sector and not just the company that's being taken over.
Julia, as always, thanks for joining us.
Thanks, Pete.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
That was Julia Lee. And before we go to Junbei Liu, let me just remind you that on Thursdays we're now doing an investing show. So you've got us on Monday as well as on Thursday, where we tend to go looking for CEOs of big companies and fund managers that you might not have heard from before. And we're going to be looking for the companies that really look like good value going forward. Well, joining me now is Junbei Liu from Tribeca Alpha Fund. How are you, Junbei Liu?
I'm fantastic. How are you?
Very good, very
That's
good.
good.
Now, just to respond to a smart aleck viewer who christened you Junbei Liu because he says you're always bringing up stocks that we should buy. And by the way, all our viewers love the fact that you give us stocks you can buy. I thought, well, maybe if just for a change, it'd be interesting to see stocks that you had previously liked and no longer like. And I hope A2 Milk is not one of them because I like A2 Milk. You have historically liked A2 Milk and they've been in trouble. So before we go into ones that maybe you no longer like, what do you think is going on with A2 Milk?
Oh, A2, look, we talked about it before. I know I do like this one. It's not in the not liked list.
Okay.
Look, it's been challenging because of pantry stock in China, and here has meant that things were very good a year ago, and now they have to cycle some of those numbers and thinking things are looking a little bit tough because people no longer, well, the shops are open, especially in China, and people can go to shops and buy things. So there's this huge unwind of the stock that inventory that people already built up. And secondly, is because of the borders are closed. So a lot of those Daigou channel has been disrupted.
Yep.
So people just simply can't buy those infant formulas from here and ship it to China. So that has created a lot of issues. So earning has been downgraded many times in the last 6 months, pretty much, simply because of this sudden shut off of the one distribution channel, which has been quite meaningful for the business. Nothing wrong with the longer term business, but shorter term, the earning it's looking a little bit tough. One more downgrade, and my view is that when that downgrade comes, share price is not going to fall any further because it is trading at that deep discount to what it really is worth. So take a 12-month view, it'll be much higher than what it is today.
And the thing is, a lot of people, when they talk about investing in companies, they say look for the best of breed in that sector. And I don't think there's any company out there better than A2 Milk when it comes to baby formula and the stuff that's selling into China.
Exactly, the brand, you stick to the brand. Brands are very difficult to build in today's world because it's so competitive, especially brand that Asian consumer, they resonate. We talked to the Treasury wine before, it is a brand that is difficult to build and it took years to build that. And once that clicks, it just represents significant amount of value. When things improve, there will be pull through because consumers still looking for those premium labels.
Okay, so let's go to the stocks that once upon a time you liked and you no longer like, and why?
Look, given we actually are long-short managers, so we actually do have a lot of stocks we don't like.
That's a good point.
Yeah, that's right. Yeah. So, but look, I think some of the stocks that were previously favorite. One example would be CSL. We love this company and we support it for many years. It just right now we have taken profit because look, the next 12 months is looking pretty tough for this company in terms of earnings. If you're a long-term investor, retail investor, you buy it and hold a few years, and share price will be fine. But my view is that because I'm a professional investor, I benchmark myself. I need to perform better than the ASX 200.
In the short term too.
At any point in time, and we have done so very well. So for me, I'd much rather to put that money into something else. Maybe the Treasury Wine, maybe Crown has done very well for us today, and or Star and the like. So it's just where I put my capital, where I can generate pretty good return in the next 12 months.
And a lot of people forget this, that your competitive advantage as a long-term investor is that you can buy the stuff that you're dumping at good prices because you can afford to wait. Someone like you or Julie or any other fund managers I talk to, they have to get it right, at least in the short term, when they present their results quarterly or whatever.
That's right, absolutely. So as a retail investor, you'll be buying and put it under your pillow, and one day share price in 2 years, share price will be much higher. Another one actually represents a bit of opportunity. We took profit maybe 6-7 months ago. Is ResMed, and again in the healthcare space, which at the moment is a bit out of favor. It's actually looking very interesting. This is one company that the sleep business where they provide the ventilators, and the sleep business have been impacted by COVID. But because so much ventilator was sold, so the earning actually grew during COVID. But then everyone see this company as a COVID beneficiary, so now being sold off because when things get better, there won't be as much ventilator required. But don't forget, this company's sleep business for sleep apnea has been impacted during COVID, so it's actually going to grow throughout, even in that recovery phase. So it's actually
this is
really
a
cheap.
buy stock as opposed to a sell stock.
So this is what we at the moment we don't have it because we took profit maybe 6-7 months ago, but it's come off so much that makes you see relative value. So as a long-term investor, you'll be putting money.
So it was one you didn't like for a while, but you're starting.
Now it's looking interesting. I'm sorry, I'm presenting another buy idea,
you
but
can't help it.
Can't help it. That's right. So, but look, there's but for me in this market, the things that you will be taking some profit in were, of course, some of those COVID winners. You can't help but.
But one interesting thing is, and a lot of people were suggesting, okay, JBH and Harvey Norman have done so well, they must come off the boil, but they've gone for a nice ride, particularly since the job number last week. Is that part of the reason why both those stocks did well last week?
Yeah, I think it's part of the reason, but it surprised me also. JBH almost back to all-time high.
I know.
And it certainly seems like, look, earning will look pretty tough, and these companies will struggle a little bit, same as Coles and Woolworth, right? Earning next 12 months will struggle because the like-for-like growth will be negative.
It did so well during the lockdown.
Yeah, and the supermarkets, some of the comparable, so like-for-like number now is already in the double-digit negative because toilet paper, people started buying toilet paper about now last year. So, they saw the first wave of increase. So now that they're going to cycle that, take a 2-year view, things will be fine. It's just that in the next 12 months, earnings is going to be quite negative.
Is there a tech stock that you've fallen out of love with? Because tech stocks generally, particularly in America, have been clobbered.
Yeah, so look, I'm always of a view that I don't like to, chase the sentiment, market sentiment. Everyone's selling tech stock and you sell it, and then everyone buying value stock, you buy. I always believe in you can always find things that make money, whichever space of the market. And I always constantly try to pick up those oversold businesses, tech companies especially. These are very high quality businesses. If they've been sold off so significantly, time to get back in. One of the name is Xero. I've gone back in because my view is that this is very high quality companies. In 5 years, it will be so much higher than some of those value names. And other tech names, well, the tech names we've fallen out of love a little bit will be the ones that sort of struggle in terms of earnings. It's always come down to the earnings. Appen is the one we find a little bit challenging, just because of the result have shown some weaknesses in terms of earnings, not just COVID. There was a couple of reports that came out, talked to potentially this whole space is becoming a bit more competitive.
The AI space
has become a bit more competitive, and so we kind of just need a bit more evidence of whether it's a short-term short-term disruption or whether it's a longer-term structural issue. So this is something that we, sort of just a bit cautious on.
So you used to like it, bit of a question mark over Appen now, but as its price falls, and it has been fairly weak, do you suspect it's going to be reasonable in the long term, or it's going to be challenged in both the short and the long term?
Look, I think it's about the next couple of results. You need to see what's happening.
Is it a trend?
Yeah, because right now you can say it could be just COVID impacting everything.
Yeah.
And when COVID come back, maybe it'll be okay. And then they change the thesis. The thesis should be long-term structurally, it's not challenged. Then it's fine. You will be buying this stock.
The jury is out on this.
Yeah, that's right. So we're not sure yet. So we have to see.
Any other ones that you've fallen out of love with?
I think I just love to buy companies.
You're finding it very hard.
Yeah, that's right. Very challenging.
What is the stock you've most shorted in your?
Okay. I think I try not to talk about my most shorted stocks.
You're so kind.
Yeah, that's right. Because the company don't feel too happy with us.
So you don't have to reveal what you're shorting.
Yeah, sure.
You don't.
No, we don't normally reveal the shorts. We have spoke about it publicly a few times, and then we find it does damage the relationship with the company.
All right. So one last stock you're buying before we go. I know it's impossible to make you to be an aggressive seller. So one last stock before you go.
Okay, so given it's topical, I will be talking about the Crown today.
Yeah.
I really think it's if you hold Crown, you don't want to sell it. Not yet. Share price up 20%, but I think there's a lot more to go. I think,
when the Royal Commission came, a lot of people would have thought, well, the Royal Commission is going to be bad for the share price. But this takeover you think it looks quite convincing?
It looks very convincing. Whether it's a whole business or parts of business they take over. Remember, a few years ago, previous bid was at 14.50, and obviously now the price is come back always before COVID and the like. This is a business that has hard assets, hard real estate assets. All these premium location in Sydney and around Australia is incredibly valuable. Yes, the license and everything with changes in management, or if there's changes in control and it might actually be good for for it to actually improve on this transparency and everything else. So on that basis, I see more value absolutely for this one, and on that basis, if you look at stars and everything else, actually one of those. The whole sector looks very, very cheap as a reopening play.
Jimbo Liu, great to see you.
Thank you.
That's Jimbo Liu from Tribeca Alpha Plus Fund. Well, joining me now is Paul Rickard from the Switzer Report. Paul, how are you going?
Good, thank you, Peter.
So today he's going to talk to us about 4 income stocks. And what's the characteristic of an income stock, Paul?
Well, I think an income stock, Peter, is something that's pretty boring. I know that sounds boring, folks, but what I want is a company that I know is pretty consistent. It's got good, reliable earnings and has a reasonably high certainty that can deliver for you as a shareholder.
Yeah.
Now, typically that means there's probably also not a lot of price volatility. You don't want to see your capital go down.
No.
And you probably don't expect a lot of capital appreciation either. So that's why I use the word boring up front. Pretty steady, pretty even, a little bit of price risk, but mainly I wanted to make sure that I want to get the income.
All right, one interesting question I think I should ask you is, the 4 you've selected, do you suspect there is a bit of a price upside? Because a lot of the income stocks have been ignored because dividends have been pretty crappy since the coronavirus.
There certainly is price upside if they're able to increase their dividend from year to year, and then ultimately that's what a share price is about. It's really about that prospect of higher earnings. So and has that translates back to earnings for you as a shareholder. So if they are increasing it, certainly there should be some capital gain over time. But some of these companies look more on the sort of the trust side. In other words, they own other assets, and the income increases are often fairly small. So look, I'll go with the flow on this one, Peter, but I would prefer to get the certainty of the income and not have too much downside. I should point out that I've excluded all the major banks in this exercise and a lot of the resource companies, because the resource companies at the moment are paying super dividends. But we know that's not going to last for a day.
And working out when it stops is going to be very interesting.
That's the really hard part. And if you're any smarter than anyone else, I can tell you the market ain't any good at predicting commodity prices. No? So I prefer to leave that to others or leave that to the market. And I think with resource companies, you're getting some great dividends on your BHPs and Rios and Fortescues.
But it doesn't always happen.
But you can't bank on them, right?
No. You can't, and good line, Paul.
Yeah,
Can't bank
that
on.
also
Let's
excludes
go-
the banks.
Let's go to your first one, Paul.
Okay, so the first one is Charter Hall Long WALE REIT. So it's called a long WALE. WALE means WALE, is weighted average lease expiry. In other words, what it's doing, Peter, it's investing in properties that, and it gets a very long-term lease. Typically,
tenants.
Typically between 10 and 20 years. So the average lease expiry in the Charter Hall Long WALE REIT is about 12 years. Sitting up very high. A lot of the properties are things like convenience stores, petrol retailers, invest in things like Telstra,
Big companies.
phone exchanges, logistics. It's got quite a varied portfolio, about 470 assets. It's about a $4.5 billion REIT. It's done really well in the virus. If you're looking at a chart, you'll see when it peaked in sort of about June, July last year, a lot of virus scare. This was seen as a very defensive play. It's now back at about $4.70 where it spent the last sort of 4 or 5 months. I think it's good value, Peter. At that level, you can look forward to a yield. This is unfranked of about 6%.
Yeah,
Right? And they've committed to that in terms of the distribution for the next 12 months. Not a lot of downside. I mean, like all property trusts, quite a lot of debt. And of course, if interest rates go up, that can be a bit of a negative because people will start being worrying about either they'll see them as a bond proxy or they'll be worried about when they come to refinance their debt. But the gearing's below 40%. I think they're a pretty good operator. I think they've got some great assets. Just taken on the 50% interest in the flagship David Jones retail store in Sydney, the Elizabeth Street store, at a 20-year lease where the tenant's liable for most of the outgoings and all the maintenance and so forth. So I mean, look, I think they're a pretty well run group, and that distribution is pretty guaranteed.
Yeah, if David Jones goes, that store will be the last one to close.
Well, I think there's a lot of an argument is David Jones bought it mainly for the property asset as opposed to the retailing business, but they're locked into a 20-year lease, so I think that looks pretty good.
Let's go to the next one, Paul.
Yeah, the next company I've got, Peter, is APA, which of course is the gas pipeline business. This has had an interesting little story recently. In fact, it came off in the first part of the year. Got down to work about $9. I can't work out why it's got down to $9.
Because it rebounded quickly under coronavirus, didn't it?
It's rebounded quickly back over 10 in the last couple of months. And almost, there's nothing really changed with this business because about 90% of its income is locked in. It's basically, it owns the pipes that transport the gas around Australia, particularly in Queensland and in WA.
Yeah.
That's very regulated. A lot of its revenue is regulated, very long-term leases again. And so essentially, most of its revenue is locked in for the year, in fact, for many years in advance. So a bit surprising to see it come off a little bit.
And gas is kind of a popular energy as opposed to coal.
Look, there's a little bit of pricing pressure there too, and it has the challenge of growth as one of its. How does it keep growing? Because you just there's the demand for gas and supply is roughly balanced, so it needs to actually get and demand came off a little bit during the COVID crisis, so it needs to actually work out a way to grow. But it has forecast a distribution this year of 51 cents. On a $10 share price, that's about a 5.1% yield. It's unfranked, but there will be a little bit of franking there. I would say this is an incredibly reliable, steady company. It really shouldn't even have almost no volatility in price, I think.
So far, in your first two stocks, we're getting about 5.5%.
Yeah, 5.5 on average. That's unfranked, so but that's where the higher yields are, and it's in those. The reason that both those companies are unfranked is that they borrow money, right? And so essentially they're buying assets and they're managing those assets. And of course the interest cost largely, the deduction they get for the interest largely offsets the tax they pay, and that's why they can't frank the dividends.
So if a company's not paying tax to the Australian Treasury, you don't get franking.
You don't get franking credits, which is fair enough, right?
Yeah,
I mean, that's one of the great things about paying company tax is you do get franking credits, right? So let's not begrudge those companies that are paying tax.
Okay, let's go to the third stock, Paul.
Yeah, so let's go now go to some taxpayers. So the third stock is again very boring. Health insurance. This is not. It's not exposed to the health market as per se. This is an insurance business, right? So it's not a healthcare stock. This is actually classified as a financial stock in the weightings. Medibank Private, originally floated at $2.45. It's one of those stocks where I reckon you buy it at about under $3 it's worth buying, and above $3 it's worth selling, basically. Yeah, okay. If I showed you the charts since it's listed, Peter, that will pretty well convince you of that, right?
There, isn't there?
There is a bit of a pattern. So it's around about $2.90. The CEO had a fantastic team under Craig Drummond. Unfortunately, he's retiring at the end of June. But one of the things, Medibank in a field of, there are 30 health or 35 health insurers in Australia, Medibank is the largest with about a 27-28% market share.
It's increasing this year.
And it's actually been able to grow market share. It has two brands, has the traditional Medibank brand we all know, which is the premium brand. It also owns the AHM brand. Now, most of the share had been going in that, but for the first time, the premium brand has actually increased customers over the last 6 months. And so the team is actually, when you're the number one in the market, you've got 30 competitors, it's damn hard to grow share, right? Without discounting prices, and it hasn't been doing that. So it's done really well. It's yielding just over 4%, Peter. You can bank that in.
Plus franking?
Yeah, plus it's fully franked, so that's back up to sort of the 5.5% unfranked. Look, a really solid company. I reckon he's created a pretty good leadership team. The challenge for Medibank is what happens when Craig goes.
And those three stocks now, you're still at 5.5%?
Still 0.5%. That's an unfranked
better
basis.
Than term deposits,
better than term deposits. So I like Medibank for that reason.
Term deposits, but much better return. Let's get your fourth one now.
Look, the final one comes as a surprise to many people, Telstra. A few people are actually getting a little more bullish on Telstra.
Good, because we bought cheap and recommended it cheap.
I'm getting more bullish on Telstra for a couple of reasons. One, I think that in the mobiles market, which is the main part of its business, a lot of the pressure's come out of that since the merger between Vodafone and Optus. And that pricing seems to be becoming a bit more rational.
And good old oligopoly, where all three do
well. A good
well.
oligopoly where all three can do well, and that's what I think shareholders hope for.
Yes.
Secondly, there's some upside potentially because Telstra is spinning off some of its assets, so we're going to have potentially the demerger of the towers business this year and some other infrastructure businesses, and I think there's probably going to be value in those sort of businesses.
For shareholders.
So look, it's found a bit of a base around $3. It's now around about $3.25. I don't think this is going to set the world on fire, but I think you could see this up between the 350 to 375 mark. So I think there's a bit of upside. On the dividend side, I think 16 cents this year is now locked in. There have been fears about how they would continue that sort of dividend in the post-NBN world. That's when it stops getting a lot of these one-off payments. Every time a customer was moved off the Telstra wholesale broadband or telephony onto the NBN backbone, which we've now all moved, Telstra was receiving a one-off payment, and that's helped keep the dividend higher than it otherwise would have been at 16 cents. And so the challenge for Telstra has been how to grow earnings, cut costs to actually replace this NBN one-off revenue. Most of that seems behind it. They've gone through a fairly aggressive productivity and cost-saving program. There's actually a little bit of revenue growth almost starting to appear. And I think there's more certainty around the dividend in future years. So at 16 cents, Telstra's yielding about 5% fully franked at $3.25. That's not too bad.
So it creeps up towards 6.5.
It creeps back up towards that overall, that 6%. So therefore, stocks, no banks, no miners in that group, quite diversified. I don't think there's that much downside risk. To say that we've seen what happens in last March.
Yes.
Everything goes down when things go wrong. No shares immune, and even that doesn't mean that an individual company can't lose their CEO or have a big accident or get caught in some sort of thing they didn't expect. So there's always risk, but I think risk is manageable, and I think there's a reasonable certainty about income there.
Okay, there's 4 good income-paying stocks. Let's hope you're right, Paul. I suspect you are. That's Paul Rickard from the Switzer Report. Well, I'm catching up with the CEO of Space Talk, Mark Fortunato. Thanks for coming on the program, Mark.
Peter, thank you for having me.
Now, you've had a couple of good days on the stock market since an announcement on Friday. So why don't you tell us, A, what the company does, first of all, and B, then what the announcement was?
Sure. Well, Space Talk is a developer of a kid's all-in-one smartwatch, phone and GPS device. So it's a new type of mobile phone or smartphone specifically designed for kids between the ages of 5 and 12. And it allows kids to access the digital world and stay connected to their parents, and parents to stay connected with their kids, keep them safe, but in a very responsible manner. So the device doesn't have any access to social media, YouTube, Facebook, those type of nasty things. But it's a very safe, responsible device to keep the kids safe, and it's really their entree into the digital world, so that they're ready, when they turn 12 or 13 for a smartphone.
So what age kids are you targeting?
Between the ages of 5 and 12.
Okay. And so this is actual phone?
Yes, it's a smartphone on a watch.
Yeah.
It's a 4G smartphone on a watch.
Yeah.
It makes and receive phone calls, text messages. It has a GPS device, step counter, all of the normal things that you'd find in a smartphone.
Okay, so what has excited the market? What was announced on Friday? And now I was going to interview you beforehand, but because of the announcement to the ASX, you had to hold it back, and I understand that. It does mean that my followers missed out 2 days of rising share price. So even though I like you, I hate you as well. All right, Mark, so tell us, what was the announcement?
Well, the announcement was that twofold. First of all, that Telstra, it will be ranging Space Talk in all of its shops and online as well.
Yeah.
And that'll commence in April. And then a little bit later on in the year, they're developing a special SIM plan for Space Talk, so that they'll be able to sell it on a monthly plan.
Okay, now my colleague will eventually cut into this interview a chart showing what's happened to your share price over time. And you and I spoke 2 or 3 years ago, I think, when you first developed this watch, and the market really got excited about it and did very well, and then it came off the boil. So can you tell us why the market got excited and why the market then got less excited over time?
Sure, Peter. Well, I think the market just got ahead of itself. It takes time for the awareness to spread, for the word of mouth effect to get out there. I mean, the company's recording quarter-on-quarter growth now for many years. And I think the market just was expecting it to boom, the sales to boom within a few months, and it's just not the case. To give you an example, we've been working with Telstra for many, many, many months. Just the testing process alone takes about 6 months. So these things take time. Campaigns to get off the ground take time, but it's very much heading in the right direction. Peter, for our existing retailers, companies like JB Hi-Fi, Officeworks, Harvey Norman, we already represent a very significant part of their wearable business. It's approaching 5%, which is a huge number when we're up against a lot of other well-established big brands like Apple. So this is a new category that's taking off. It's growing very quickly, but to get to the scale that I think the market was looking for, it's just going to take a little bit more time, but we'll get there.
How significant is Telstra added to the current group of retailers that stock your watch?
Well, it is the most significant. Telstra is the country's #1 mobile network operator. It's known for its quality, reliability, and Telstra doesn't make decisions to range new products lightly. They did a lot of their own homework. They could see what was happening with the likes of JB Hi-Fi, Harvey Norman, Officeworks, and others, and they studied the market, and they could see there's this new category emerging of selling responsibly smartphones to young kids between the ages of 5 and 12, but on a watch. And they're not selling devices like this at the moment. So what's happening? It's opening up a new market for them. They're bringing in new business that's not cannibalizing any of their existing business. And then when the child reaches the age of 12 or thereabouts, when they go to high school, they just account manage them into a fully blown smartphone. Yeah.
And I guess what the group of people who you're trying to target are those parents who really don't want their kids to have an iPhone or a smartphone because they're too young, and the kind of potential dangers there would worry them. But this is like an alternative to that.
Well, I think most parents would prefer to keep their young kids away from the open internet, social media, YouTube, and all those things. I mean, it's a dangerous place. Those apps are designed to be highly addictive. And it's like, do we put our young kids in front of a poker machine? Of course we don't. And it's the same type of effect that these dangerous apps have on young kids. So this teaches and enables kids to use technology like this responsibly, parents can keep their kids safe and prepares them for the digital world.
Okay, so what are you selling now, and what will you be telling your shareholders you're hoping to sell given this Telstra innovation?
Well, we're selling. We closed the half year on revenue of 8.4 million, and for the whole previous year before that, we did 10.5 million. So we're going to exceed our full year numbers quite comfortably. The extra business that Telstra brings in, we won't know exactly for some time. Look, Telstra's got 18 million mobile subscribers, mobile services. It's a huge number. We only have to get a very small percentage of that to have a very meaningful effect on our business. But look, we got to get it out there, get into the stores. Telstra are making a very, very strong commitment to the launch. They put ranging in every store. There'll be inventory display stock in every store. They're training what's called 100 of their VIP promoters that will be going out to the company and to their large clients, explaining what Space Talk is all about. So they're getting really behind it. So the opportunity is enormous.
Mark Fortunato, CEO of Space Talk, thanks for joining us.
Thank you, Peter, for having me on the show.
Let me remind you before we go, we're also doing an investing show on Thursdays. Don't forget, Thursdays for Switzer Investing. I hope I see you there.